What? Okay, ask Benny. You are talking about, no, what are you talking about? What interest for the loan? Did I miss it? Oh, okay, so this one is not debtor's allowance. Remember, you make money in two ways. The first way, this business makes money through sales. So if there was a credit note because they were returning a product that was something wrong, we would have debtor's allowance, sales, trading stock, cost of sales. Okay? But they have a secondary way of earning money, which is services rendered. So they're doing something and the client pays them. So now the client says, oh, you fixed my button, but it broke off the next day. So what now? And then it's an allowance again, but it's not the opposite of sales. Debtor's allowance is the opposite of sales. So what's going to happen? My fee income is going to decrease. Ne? Because can you see it most has a credit balance. This is a credit balance. And my debtors is, so this wouldn't be sales. I'm lying. What would this be? This is wrong. What would be credited when I return goods? Debtors control. Okay? But this would make my sales less. Okay, so there I made a mistake. Why didn't anybody pick it up? You guys are asleep like your teacher. You must be more awake, ne? Next time you must show me. So is everybody fine with this transaction? The two things that happens. You just need to differentiate. There's a lot of businesses that has the two legs that they stand on. It's only when it's a physical sale of a product that we use debtors allowance. Okay. Thanks. Good question. I think a lot of people were wondering, but too scared to ask because I am such a horribly angry teacher all the time. So yeah, I'm so sorry. Let's go on. You guys must start laughing. Yes, even if you pretend, it's better than the silence. Okay, so let's go on. So now we have our physical stock. And what did I teach you? When they give me this physical stock count, the physical stock count, I know that that is immediately in my balance sheet face, if I can find it. It's immediately my inventory. So I'm going to say that 315 plus 4,000. Okay? Can you see? This is the stock that I have left. So now I go to the income statement. In the income statement, I'm going to look. That trading stock, if I draw a T for trading stock, will have a closing balance. Was there any stock returned? No. Otherwise, I would have put it here on the debit side. No. Luckily, I'm not your English teacher. Okay. But now, let's quickly go look. What is my stock? It's 325. So according to my books, I have stock to the value of 325. But when I count it, it's only 315. Is this necessarily a train smash where stock was stolen? No. It could have been something very simple like the owner took stock for his own use, but he never informed the bookkeeper. Ne? It could be something like that. Okay? Or it could have been that a debtor previously returned, was going to return goods. They made an arrangement with me. I already reversed it in the books, did the debtor's allowance, but he still didn't come to bring back his stuff. Could be anything like this. Okay? So, there is now, can you see, this is a plus minus. On the minus side, I short 10, which makes this a deficit. So if I go to my, where is it? income statement, I'll have a trading stock deficit. Can you see this is how you abbreviate? Okay? And please don't just write trading stock, because trading stock is an asset, and then I'm going to say -1 foreign item. I'm listening. Okay, so now the 4,000 consumable stores. What is this? Now remember, can you see they didn't say consumable stores on hand? Can you see that? But what are they telling you? They are telling you when they counted the consumable stores, the Andy, there was still 4,000 rands worth left. And that makes this consumable stores on hand. So basically what it means, if I do my consumable stores T account, that 4,000 will, remember I bought stock. How much was my consumables? I bought 104, 100, and this I divide between used and unused. So the unused would be that 4,000. Okay? And that's why it goes to the balance sheet. But the used, can you see I'm subtracting it? So now I see, oh, I only used 100. You see? Just remember, your income statement is about what did I use? What was my expenses? I don't want to subtract the 4,000 because I haven't used it. And why would I subtract something I haven't used yet, and my net profit is 4,000 less than what it really is? Okay, next one. And now we get to our favorite, salary and wages. So the first thing I know, the income statement, I'm going to show the gross and the contributions. The balance sheet, I'm going to show whatever I need to pay, and I'm going to show it separate per fund. So I'm going to have my creditors 4, and then I'm going to have all my funds, which I take the balance if there is, the deduction and the contribution. Okay, please go look at this. So now let's see. Firstly, I always like to do my income statement first. So let's see what they give me here. Can you see that it says net salary, deduction, deduction, deduction? What do I know? If I add all of this, if I add this, it will give me my gross. And how much is my gross? 20? 25. Okay, now your first reaction is I go to salary and wages. Now, why don't I just immediately put a plus? Yeah. That's it. This one, they were testing your reading abilities. Look at this. He was included, but he retired, so he doesn't get a salary anymore. So can you see now I have to subtract. So I need to subtract that 25. Okay? And I also need to subtract the contributions. So now let's quickly look. They say contributions were pension, 10%, 10.5 of the gross salary. So it's the 25 times 10.5% gives me how much? 2625. UIF is rand for rand, 250. Okay, now I'm asking you, remember you've got 3 ways that you can show contributions. Please, first one, you showed with salary and wages. Second one, you showed separate as employer's contribution. Third one, you showed even more separate. You will say pension fund contribution, UIF contribution. Okay, so if there's no indication, like if they didn't give you that note, there's no indication in the trial balance that there's a T account for contributions. Can you see? Then you can do whatever you want. Any one of the three would be right. But now in this case, they actually gave me a thing where they say all contributions are debited to salary and wages. So now you have to do the first method. And I have to subtract. And what am I going to subtract? And I don't have place, so I will just go on here. I will say minus 2625 minus 250. It's always safer not to add them. Ne? Not to say, oh, minus 2875. Reason being, it might be that you calculated this pension wrong. Ne? And now you add something which is straightforward, but now your final total is wrong. Then you don't get your marks. Whereas if you show it to me separately, you might still earn extra marks. Okay. Everybody fine with salary and wages? What is the answer? 260, 215. Okay. Now, I need to do the payables. So, can I quickly show you a little shortcut here? Because in the payables, what do I want to show? In the payables, I want to show what everybody earns. So if I did a note, I'm going to do the note quickly for you that you can see, because this is so many marks. I really want you to have it right in the test. If it was a payable, what's going to happen now? It's going to become receivables, So you're going to have in your receivables. So actually we need to go take it over now to the receivables in this case. Do you understand what's happening? Okay, let me quickly say to you. Remember when we did the payables, So the payables, we would have creditor for, what was this? A salary. They gave me a payee, they gave me a pension fund and a UIF. And here I will take the deduction and the contribution. The deduction and the contribution. Okay? So if it was that it was left out, we forgot to put it in, which is easy. In other words, all of this was pluses, because we still need to put it in our books. Then it would have looked like this. The net salary would have been 18,375. The payee, the pension fund would be the 1875 and the 2625. Any total there for me? $4.5. Okay. Now, UIF would have been the 250 and the 250, which would give me 500. Can you see? This is how you did previous exercises. Everybody show. So then, if I had to go to the income statement, I will show all of this together as one amount. You can see. If you say that 25, 2625, 250, it will give me what? 27. 27. 875. And quickly add this and see if you get 27,875. You do. Okay, so this is how it would look like. But now in this exercise, what's happening? We recorded a person who's no longer working for us. So can you see everything now is going to be a minus. Am I allowed to show a payable as a minus? Because is it now a payable? No, I don't need to pay it to him. He needs to pay it back to me. So can you know, If I pay you salary, you're no longer working for me, what are you going to do? You have to give it back. So now, what does this become because it's negative?
Receivables.
A receivable. So in other words, in this case, I will have in my receivables, I will now have a plus 27,875. Ne? Because what's the opposite of a payable? So let's just take this scenario quickly. Let's say I still had in my trial balance here in the balance sheet section. Let's say, for instance, I had a SARS payee, ne, for 70,000. Meaning I still haven't paid over to SARS. Ne? Can you see that SARS payee would then still go into payables because 70 less 4 is still I'm owing. The reason this moves to the receivables is because everything here was 0 to start with. Everything was already paid. You get it? In other words, when someone, and let me just write down those options for you. If someone is not put in, ne, but should be there, ne, then we're going to plus everything. If someone is put in, but should not be put in, we're going to minus. When we go to the balance sheet, however, right, it's all about how much do I owe, right? Do I owe this guy that's put in that shouldn't be put in? No. So I'm going to subtract it from the creditor for salary, from the pension fund. But can you see, if all of those people have already been paid, ne, then those things becomes receivables because I need to do the opposite than what I did when I put them in. I need to go opposite. Remember, overstated, go totally to the other side. And that principle goes with everywhere. Okay. But let's say the amount for pension fund was 700 and this guy was going to receive 70, then this would still be a payable of 630. It's just once it moves negative, ne? You're not allowed in the note for payables to deduct, to have a negative final answer. Because the moment in a payable, when you have a negative final answer, it becomes a receivable. Okay. Yeah. Is everybody sure? Let's go on. Let's not dwell on the past. So let's go to the loan. So everybody shop with that one. And actually it would be better to write it separately. Ne? Every amount that makes up that 27,875, to write it separately is actually better. So you would write plus 18, plus 45, plus 187, plus 250, plus 26, plus 250. Okay, it's safer to show it like that. Or on the side, show the calculation, and then you just make a little star of it, and you show the calculation of it separately there. Safer. Because each one of these will literally count a tick in grade 10. Okay. So, let's go on. Next is the loan statement. Now, when I do the loan statement, the first thing I know is that I am now going to calculate the interest expense. Ne? The interest on loan. So, I draw my T for loan. I have an opening and a closing and a bank and a interest on. Okay. So, opening 665, 600. 103 200 and 652 000. Okay. Now, what is the interest? So it's 89600. Anybody with a problem to calculate this? Okay, and please remember your bracket. Okay. Now if I go to the face of the balance sheet, I'm going to take the closing 652. So what is this? This is what kind of loan is it? It's a mortgage loan, and it's from Kelly Bank. Okay, and the closing is 652 000. Can you see in this case, this was the closing, but you must always just double check if there's extra info. Okay, and now I want to subtract my short-term loan. So whatever goes here, and you can't see that, it's too light, this thing is dry. Ooh, let's try the pink. So whatever goes here will also go here. Okay, so now let's go see, what do they say? Interest for the year must be capitalized. A capital amount of 50,000 will be paid in the next financial year, which makes this my short-term loan. 50, 50, and that gives me 602, 602. Everybody happy? Next one. And this is also a new one. And I want you to please listen. Is everybody sharp? Can I move on? Okay. So this one, it's also an adjustment you've never done before, right? So it's a different way that they give that 10% increase one. But this is actually an easier way. Okay. So, let's have a look. They tell us he owes us rent for June. Now, if I go look at my trial balance, which is now just gone. Who stole my trial balance? Oh, I did. Okay, can you see? My year ends 30 June. Okay? So in other words, if I draw a financial year, it ends 30 June, started 1st July, they tell me he owes me June. So that's accrued. So if I go to my income statement, which is now also gone, if I go to my income statement, I know it's going to be a plus. Why do I know it's a plus? Because they still owe me. It's accrued. It's not. He hasn't paid too much. He's paid too little. Okay. And now I know I'm going to work with 11 months. Because month number 12 he did not pay. Okay. You guys with me? Now they say we had an increase on 1st January. So on 1st January, he suddenly started paying more. How much more? 1,500. I'm quickly going to show you something. So before, July, August, September, October, November, December, every month he paid X. Ne? But now, after the increase, and I'm not going to write it for all the months, he paid X plus 1,500. Ne? So what I'm going to do is I'm going to see how many months did he pay 1,500 more. January, February, March, April, May. He still owes June. So for 5 months, he paid 1,500 more than the other months. So that gives me what? 7,500. So now what I do, can you see, if I get the 7,500 away from the total, it's like there was no increase. So I take the, where is it, rent, 172,500, I subtract the 7.5 and I see, oh, okay, if there wasn't an increase, né, the rent would have given me 165. né? You see that? So this is for 11 months, and the answer I get is before the increase. Okay. Woo, sorry. So how much is it before the increase? Take your calculator. 15,000. Meaning it was 15,000 more per month before the increase. With the increase, it would be 16. You see? And is that month that he owes me before or after the increase? After the increase. So it would be 16.5. And you can go calculate. If you take how many months? 1, 2, 3, 4, 5, 6. If you take 6 months at 15, né, and 5 months at 16.5, your answer will be 172,500. Can you see they could have also asked you, there was a 10% increase, né? If they've said there's a 10% increase, 1st of June, 1st of January, and this guy owes June. Can you see that's the other method? Then you'll also get 16.5. You guys with me? Okay. So now I'm going to add 16.5. But now remember, it's an accrued income. And an accrued income, what does an accrued income do? It makes my receivables more, right? And it makes my income in the income statement more. So now my rent is how much? Is this right? Yeah. Okay. Everybody shout. You count, count months after increase that we really received. Okay? Now I take those months and I times it with the increase. Then I take the total I received, I subtract that amount I got in number 1, and I get the rent if no increase happened, and I divide it by the months I received. Then my answer would be 1 month, né, at the price before the increase. Okay, and so I just add the increase and I get the new amount. Does this make sense how I'm writing it? Can you? Okay, next one. So the next one I see, oh, blipskottel, where is my stuff? I'm not supposed to say that word. Where's the rest? Oh, here's the rest. So now I see, oh, it's good I looked for tangible assets. Because what do they tell me here? They say here, land and buildings on the 1st is 11. So in other words, the opening is 11 million, né? Which isn't, it sounds very high, but you know what, depending on where you buy a house, yo. But in any case, and there's no accumulated, né? And now I know that the trial balance, which is gone again, the trial balance is the closing. Okay. So the closing is 10.2. And now you say to me, but ma'am, this is less than 11, and we have never ever in our life done the disposal of an asset, sold an asset. But now I'm testing. Because I taught you something, you are also supposed to be able to do the opposite. Okay? So now what do you know? You will just take the difference, which is 800,000. Okay? But now it's not an addition, it's a disposal. So you put in there 800,000, and now it's no longer an addition, a plus, it's now a minus. Okay? You guys got it?
And what is the disposable?
Disposal means I sold it. I sold the fixed asset. So I had buildings to the value of 11, now only of 10.2, which means 800,000 was sold. And remember, you don't show the sale price, right? You show the cost price. So it doesn't necessarily mean that the money you got was 800,000. But that we don't do in school. Okay, is everybody sharp? Is there anything else that's a little surprise somewhere? Yes. A new vehicle was. Okay, so always remember, the balance they give you in the trial balance, this, like this, land and buildings and vehicles and equipment, this is always the cost price. Okay? It's always the cost price. What is the carry value? Is when I take that cost less the depreciation. Then I get carry value, the accumulated depreciation. But now, with land and buildings, they don't depreciate. And we do not do appreciation in school. We do not do where the value goes up. Okay? So we always assume that the land and building was sold at the same value that we bought it. We got the same price, we paid for it. We don't make a profit or a loss or anything. Okay. Is that answering? Okay. Everybody sharp? Okay. Next one. A new vehicle for 200,000 was bought 30 June. So I have addition. 200,000. Okay. Now the question is it recorded or not? They told me it's not recorded, but not like usually where they give me a little sentence. They actually told me that this is the opening balance, which is just as good as telling me it was not recorded. Okay, so I now know 900 plus 2 gives me 1.1 million. Okay, now I just need to depreciate. And if I depreciate, I know it's always new and old, right? And now I go, look, what's the method? And they say it's 20% diminishing balance. Now that diminishing balance is only valid for the old one, eh? The new one is 200, 20%. When did I buy it? On the 30th of June. So how many months did I have it? 0 months. So the depreciation is 0. So actually you don't even have to do that. So now let's go have a look. They say the old was on diminishing balance, meaning which one will I use? The 9 or the 5? Diminishing, the lesser value. The 510. 20% for the whole year gives me 10,200. Huh? No, it's for the whole year. Remember, you split. You split. Why would you want it for 10 months, baby? Because if you look at this, you already had at the start of the year. When are you doing this? The end of the year. How many months is that? 12. Okay. Is everybody sure? So what does it give me? 10-2. Huh? 10-2. So I'm just going to write it in here. I'm not going to write everything out. And now I just need to plus and
I guess we're on the side. A double